Hi, and welcome back. Let's discuss a common question we receive in attempting financial move. Should you use a portion of your 401k to pay off debt before rolling it into a new plan? If you have a workplace retirement plan such as a 401k, 403b, there may be times when you're tempted to take an early withdrawal before the age of 59 and a half, which is the age when you can withdraw and no longer incur a penalty. However, before you crack open your retirement funds, you should understand your options. Let's review the rules for early withdrawals and pros and cons of using your retirement funds to pay down your debt. In 2025, you can contribute up to $23,500 to a workplace plan and $31,000 if you are 50 years old or over. Additionally, many employers incentivize savings by matching a portion of your contributions. This actually allows you to exceed those annual thresholds. The funds are meant to be used for income in retirement, and withdrawing from the account before you're 59 and a half years old will result in a 10% penalty tax. Most 401k plans allow participants to take loans or a hardship withdrawal up to certain limits. Hardships are specific circumstances approved by the IRS, which can include things like paying for college, first time home purchase, paying off medical debt, or even avoiding foreclosure. However, taking out money from your workplace retirement plan for something like a vacation or paying off credit card debt is not considered a hardship, and it will be subject to the 10% early withdrawal penalty. Um, the IRS basically penalizes any withdrawal from a retirement plan to discourage you from doing it. The downside of a 401k hardship withdrawal is that it isn't tax free. You must pay income tax on any pre tax contributions or earnings. What's more is you can't repay the hardship withdrawal, and you typically can't contribute to your plan up to 6 months after taking the withdrawal. This forces you to miss out on additional retirement savings as well as the employer's match. I know that no one opens and contributes to a retirement plan expecting to need their funds before it's time to retire. So we don't typically recommend withdrawing from your plan, but if you find yourself needing money and you've exhausted all of their sources, a loan from your retirement plan might be a better option for you. This allows you to tap into a portion of your retirement account penalty and tax free as long as you repay it on time with interest. If your plan allows for a loan, the limit is typically half of your vested balance, up to $50,000 maximum. If you are unable to repay the loan on time, the outstanding balance is then considered an early withdrawal, subjecting you to ordinary income tax on the amount and 10% penalty on the withdrawal. Additionally, if you leave your job or if you get laid off, the loan balance is also considered an early withdrawal unless it's repaid by the tax filing deadline. So, the benefits of a loan from your 401k can include getting your funds quickly, relatively low interest rates, spending the funds any way you need to, and even having like a set repayment term. Primary downsides of 401k loan include missing the potential investment gain on the amounts you've withdrawn and incurring that expensive penalty if it's not repaid on time. Um, Generally, the best thing to do is roll over the entire 401k balance to an active retirement plan, avoiding cashing out any amount of your funds. This is a non-taxable event, and it won't cost you anything. Rarely does it make sense to pull funds from your retirement account before you're 59 and a half years old. Tapping into your account should be a last resort because you, like we said, you forfeit any significant potential gains. Plus, if you don't have enough cash to pay the penalty and the taxes, you end up withdrawing more than you actually need to account for those things, leaving you with even less in your account. Consider other options for paying down your debt while leaving your retirement funds intact. You can budget aggressively to cut any unnecessary or extra spending for a time. This will leave you with more funds left over at the end of the month that you can send to your loan balances. If you've already cut your discretionary spending, try doing the opposite. Find something else that will bring in additional income, even if it's just temporary. If you are a homeowner, try getting a home equity line of credit. This will allow you to pay off the highest interest rate debt with a comparatively lower rate. Just keep in mind that your home is used for collateral on this type of loan. So if you can't repay it, you could potentially face foreclosure. If you have good credit, you can consider taking out like a personal loan or consolidating your debt altogether. Um, Keep in mind that this option will likely have a shorter repayment period, which consequently makes your monthly payments higher than they would be. You can also use a balance transfer credit card with a no interest promotional period. Um, this strategy really is only effective if you are able to pay off the entire balance before the 0% period is like expires. Um, and I guess like as kind of a last resort, you can try negotiating a debt settlement by contacting your creditors if you feel like you'll be missing a payment soon, or if you've already fallen behind. Um, you can try negotiating what you owe or to temporarily suspend your payments. Just be aware that this can negatively affect your credit score, but it might be worthwhile if your score is already declining. So, if you are struggling to pay down your debt and considering taking out money from your retirement plan, first call us to see if we can help you avoid sacrificing your retirement. You can reach out to us by calling the office. You can visit us on our website at braun-bostich.com. Find us here on YouTube, LinkedIn, or Facebook. Thanks for joining.